In comparative studies of Western economies, Belgium stands out for a highly unusual reason. Its income inequality appears immune to the upward spikes seen in almost every other industrialized nation. That academic consensus is built almost entirely on data extracted from standard household surveys, specifically the EU statistics on income and living conditions. These surveys track a specific metric known as household disposable income. This is the actual cash families have left to spend or save after standard taxes are paid and government transfers are received. According to decades of these official, self-reported responses, the gap between the richest and the poorest citizens in Belgium has remained flat. But this data directly contradicts the lived experience of the general population. In a recent OECD survey, over half of Belgians reported that income inequality had increased over the last decade. The problem lies in the structural limits of the survey process itself. Researchers face high unit non-response rates from the wealthiest citizens and significant misreporting of financial assets at the absolute top of the distribution. Trusting the official consensus of a stable economy requires ignoring both the known mathematical flaws of self-reported data and the clear intuition of the public. To correct those blind spots, economists apply a methodology known as distributional national accounts, or DINA. The DINA framework takes the fragmented microdata of household surveys and anchors it to the rigid macroeconomic aggregates of the system of national accounts. It targets net national income, the true total economic pie of a country, verifying that every euro generated by the economy is mathematically accounted for and distributed to a specific recipient. This chart visualizes the impact of that alignment. The bottom line shows the flat trend of survey-based household disposable income. It appears stable until we overlay the DINA net national income calculation. Notice the divergence starting in the years following the global financial crisis. After 2012, a gap opens between the two measurements that traditional surveys simply do not reflect. By forcing a strict reconciliation between what citizens report on surveys and the actual verified wealth generated by the national economy, researchers can identify exactly where the money is going. The resulting data reveals a different trend. The actual flow of national income has shifted significantly away from the majority of households. Official survey metrics track a specific narrowing segment of the economy, while the DINA framework captures the movement of the entire national pie. To understand exactly how the survey data drifted so far from reality, we have to break down the actual components of the national economy. This chart tracks the cumulative growth of macroeconomic indicators since 1985. The top lines represent gross domestic product and net national income. The lower blue line represents the net disposable income of households. While the total national income generated by the country grew at 1.8%, the share reaching households grew at a slower pace. Analyzing inequality exclusively through household disposable income ignores macroeconomic factors, like corporate depreciation, which grew at 2.6%. Significant pools of national income circulate through corporate and government sectors. Because they never directly reach the household sector as cash, they aren't captured by survey data. Thus, the household share of primary national income fell from 92% in 1985 to 77.5% by 2022. Traditional metrics report a stable economy because they are grading an ever smaller fraction of the total national wealth. The discrepancy becomes obvious when we look at how traditional surveys handle different types of income, starting with standard compensation. For employee wages, salaries, and pensions, household surveys match the strict macroeconomic data almost perfectly. But these surveys struggle to measure financial capital income and corporate profits. This diagram compares the capture rates. On the left, surveys capture roughly 100% of national wage data. On the right, they capture a mere 14.8% of aggregate interest income. For undistributed corporate profits, totaling 43.4 billion euros in 2019, the capture rate is 0%. While retained earnings are not paid in cash, they accumulate on corporate balance sheets, driving up the net worth of shareholders owning that equity. By ignoring tens of billions in concentrated corporate equity, surveys systematically undercount wealth accumulating at the top of the distribution. While wage disparity across the general population remained stable, DINA data reveals that the spike in inequality originated from a different source. The primary driver is a shift in how capital generates returns following the financial crisis. This chart breaks down the individual components of national income over the last 4 decades, mapping the movements following the 2008 financial crisis. Notice the bottom line: interest received by households. This income source once accounted for over 11% of the national income, but plummeted toward zero as market conditions changed. In 1985, households received nearly 22 billion euros in interest. By 2020, that amount had fallen to less than 1 billion, effectively evaporating a form of wealth generation accessible to the broader population. Contrast that collapse with the growth of the top 2 lines: highly concentrated corporate equity returns. Undistributed profits held by corporations grew at an annual rate of 5.6% after the crisis, far outstripping the 1.4% growth of total national income. Direct dividend payouts to shareholders followed the same upward trajectory, increasing from 5.8 billion euros to 17 billion. Modern inequality is driven by this transition, the loss of middle-class interest yields paired with a boom in corporate equity. We can see this transformation by comparing the total composition of net national income in 1985 directly against 2022. In the 1985 baseline, interest income represented 11.2% of the entire national economy. By 2022, the interest segment had shrunk to just 1.3%. Simultaneously, the share of net undistributed corporate profits expanded, swelling to command 12.6% of the national economy. This shift occurred outside of the view of standard household surveys, creating a statistical impression of economic stability that the lived experience of citizens contradicted. The narrative of low, stable inequality in Belgium was the result of incomplete measurement. Understanding modern wealth concentration requires looking beyond standard wages to track the underlying architecture of capital returns. That architecture is influenced by the monetary policy and institutional shifts that dictate how capital is valued in the economy. Relying solely on self-reported disposable income means national policymakers are crafting legislation based on data that misses billions in corporate earnings. Without adopting the distributional national accounts framework, governments cannot effectively assess or address the concentration of wealth they do not currently track. Until the true macroeconomic ledger is acknowledged, the wealth accumulating through corporate equity and retained profits will remain invisible to official reports.